Where are the fastest areas of growth then for alternatives? In terms of demand and pull.
Yeah, look, I'd probably separate alternative into probably 4 buckets in broad terms. One is your sort of more liquid credit alternatives. The second is more illiquid credit alternatives. The third is hedge funds, and the fourth is venture capital / VC. You can probably split them out into 2 themselves. And each one of those alternative categories offer a very different risk return profile. What we've seen probably over the last 5 to 10 years is a real growth, if you go back 5 years ago, a real growth in allocations to private equity and VC. And that was certainly where a lot of capital was going to. Now you've got a little bit of a problem there in terms of investors being locked up into an illiquid market because that IPO market has stalled a little bit. And you've also got a situation where a lot of the funds are not taking in new capital, so you don't have the exit that a lot of those private investors would have wanted. But that's certainly a big part of people's portfolios at the moment. That sort of led into where we are now into credit and that private and public credit. And I make that distinction because the vast majority of credit funds in Australia are property orientated. And the more liquid side of credit is very different when you're looking at securitized products, structured products, and even very simple sort of corporate debt. So you look at that and we've seen a huge allocation shift towards that sort of public credit because the risk profile is very different to what we see in the equity market.
Okay, and if we just sort of pin in the map at the moment, this point in time, where we are, if we take a step back at the broader macroeconomic environment, you mentioned some of the lockups in the VC, and obviously there's some areas of those markets have ran quite hot here and elsewhere. If we're at the top of the cycle in terms of robustness, performance, and so on, let's say you're a broad-based asset manager, where would you be lining your chips up in terms of a focus, let's say, for the next 2 to 3 years? Where are the opportunities to sort of drive forward?
Yeah, look, and I think the answer in that sort of alternative space is a diversified mix of a number of products. And that's probably, the easy answer to give, but that's the reality, and that should always be the reality. Okay. But certainly I think we are seeing a bit of that private credit start to turn. So we are now seeing the risk come through in a lot of those products, which we haven't seen for the last 3 to 5 years. And I think that's making people question, is the returns or are the returns that we've got over the last 3 to 5 years sustainable? And we are starting to see a change in return profile there. So I think having a more balanced, non-property orientated credit exposure is going to benefit a lot of investors.
So where do you look for then, if you're looking outside of property? What sort of origination are you looking at for the credit products?
So I think if you look at, say, where we're allocating to in our fund, you've got a lot of securitized products where you're getting a really good return for the risk that you're taking. So things like asset-backed securities are looking attractive and have looked attractive. Spreads were certainly attractive 2 years ago. They have contracted a little bit, but when you look at the risk profile of that versus, say, the risk of a direct property loan, it is very different. And your liquidity profile of that is very different. And if you had to work out the asset in default, it's very different.